Last week was a positive week for the stock markets. Typically a little bit weaker this time of the year, but not last week. Although we are coming up to the two weakest weeks of the year on average over long term, the last 2 weeks of September. So we'll have to see how the markets can perform in there. What's really happening right now is investors are seeing everything as a bullish sign, even bad news. We saw some of that going back and forth where bad news was interpreted poorly. But really, it's recently the bad news is being interpreted as being good news right here. We also saw the rate cuts. We saw the U.S. Have a rate cut, and Canada have a rate cut as well. And they're dramatically different where the overnight rates are for those countries and where they could be going. We're going to talk a little bit about that. What drove the markets higher? We'll take a look at the winning sectors as well and what we can expect coming up shortly. Okay, so let's start with the U.S. here. We saw the U.S. Federal Reserve cut its rate to 4.25% last week, down 25 basis points. Powell came out and made some hawkish comments after the fact, and yes, they can cut rates again, etc., but he wasn't pushing on that at all. But the market still saw that as being positive. Right now, the market's actually looking at this and saying, well, by next July, we're expecting 4 rate cuts, which is down another 1%, which would take it to 3.25%. And you can see that graph coming down this way as far as the expected rate cuts. If we look at Canada here, we see that Canada the Bank of Canada made a 25 basis point cut as expected to 2.5%. That's much, much lower than the US rate. And that's the big difference. Canada can't cut that much anymore. If we take a look within the year, they're expecting right now in the markets with probabilities making 1.2 cuts. So one more cut in 1 year's time. That's not the way investors are seeing this right now. They're thinking the Bank of Canada is going to try and keep up with the Federal Reserve moving lower, but we're already at 2.5%. This is already below the long-term average. Long-term average, including that time period from 2008 to approximately 2018, where the Bank of Canada kept the rates too low for too long, and it really was, a bunch of that was a policy error. And so artificially that average is being brought down, but the average from 1993 has been 2.75%. So we're below that. And the stock market's at an all-time high. The economy, yes, where it looks like we might be slipping into recession, is weakening here. But the Bank of Canada needs to save some tools here as far as being able to act if we run into economic problems. The Bank of Canada does not want to take this rate down into the one handle range or get close to 0%. It just does not want to do that here. And rightfully so as well. So if we take a look at this, so we're looking at the cuts here. These are all incremental cuts. These aren't full cuts, and we end up with 1.2 cuts by a 1-year timeout, and we're down to, in this case, 2.25%. So only one cut within the next year is expected. If we take a look at this graph here, this is for the Federal Reserve and expectations of rate cuts that are coming out. We take a look from the start of the year here, and this is the blue line. And you can see the blue line was for some cuts to happen and end up about in this time period next year, around a little bit later than this time. So we've seen rate cuts adjust downwards in that time. In the case of this white line here, that's from May, okay, what the expectation was. And we saw the rate cuts start to pick up here, go all the way down here, and ended up at this point. If we take a look at the current path of expectations right here, in this gray line, we can see it's right at this point here. So we've seen an adjustment downwards over the longer term, just over a year out, for more rate cuts from the Federal Reserve. And that's what's helping to drive the market higher at this time. This week, Canada also had its inflation numbers come out for the week here. And the headline inflation, 1.9%, and that's what the media focuses on here. But the Bank of Canada has stated numerous times that it focuses on the CPI trim and the CPI median. These are the numbers that the Bank of Canada looks at. And if you take a look, they're at 3%, 3.1%. So despite what you hear in the media, this is what the Bank of Canada is focusing on. And 3% is not 2%. So they still have a way to go down with these metrics here, the numbers they're looking at. So they're still battling inflation. The inflation battle hasn't been won in Canada yet. Okay, so let's take a look at the results last week. Here we saw the S&P 500 up 1.2%. The big winner was technology here. We've seen technology bounce. It typically doesn't perform well at this time of year. It had been underperforming the market, but we saw that bounce as we moved to a risk on. Communication services, consumer discretionary. So the growth sectors of the market really did quite well last week. That's partly because of interest rates coming down, but that was already expected. It's more about the expectations for the future. As interest rates move lower, that tends to help the growth sectors, because when you're buying growth sectors, you're buying a longer stream of income, and as interest rates move down, that opportunity cost diminishes. If we take a look at the other sectors of the market here, the defensive sectors, consumer staples, healthcare, utilities were all negative for the week. Telecom was also negative. Real estate was negative. Really, it was industrials that were also did quite well. Financials did okay here, but industrials have actually been performing quite well this year. I'll show you a graph in a second about that. But there was a risk-on movement last week. Okay, so if we compare the U.S. to the S&P 500 here, we can see the TSX was up 1.7%, and that's a lot to do with the mining stocks. We'll talk about that in a second. Small caps up 2.2% in this environment. Falling rates help small caps. We've seen that actually driving small caps up here at this point. We're going to take a graph in a second. NASDAQ did quite well. If we take a look at the emerging markets, 1.1%. Europe down 0.1%. Europe was not bullish at all last week. We saw a continued negative movement for that economy. It's becoming quite well known that the UK is in financial trouble. France is in financial trouble as well. Germany has been in and out of recession. So it's putting all the pieces together. Investors perhaps are looking at the underlying economies, which can perform differently than the stock markets. But when it starts to build and the economies really start to show a lot of weakness, then the economy does become more and more important. Okay, here are the sectors of the market, and we have to talk about this. Uranium up 17.6%. Its strong seasonal period starts very shortly. It's been trading in a consolidation range and is broken out. This was just huge. Really? There wasn't really any news, which is a surprising thing. We saw sectors of the market move strongly without substantial news driving them. Like, yes, there's always positive news for the uranium sector. But the price of the underlying uranium is also starting to move up here. And the narrative about who controls the price between the buyers and sellers is also starting to change. So this is really interesting what's taking place, and we did see that move up higher. The other one that we took a look at here was gold miners, up 3.7%. Now, gold miners were up 5%, just over 5% on Friday. Why? There was no news. Absolutely no news. It was negative earlier in the week. And then we saw gold miners move up. Gold, silver move up strongly as well. There are some rumors that there was a large position being taken in gold miners. Berkshire Hathaway name was being thrown around. Who knows what, but there was no news that was really put out. And we saw that sector respond strongly. Well, look at the other winning sector here last week. If you get the theme here, metals and mining. So we're seeing this shift taking place. And I'm going to talk a little bit about what could be driving this. So this is really on not any strong news here, but I want to talk a little bit about what's changing underneath that could be driving this. This is a reality check. This is year to date, the S&P 500 in its different sectors. The black line here is the S&P 500. Up here, communication services, think Google, Meta, etc. Then we have technology here, another well-performing sector. And I told you I'd talk about industrials. Look at this sector here performing well. Its major bounce here in blue was right in this time period, right after this the whole tariff situation, all the tariffs being really bantered around in the media and how it's going to help the industrial sector. So we did see that strong move higher. If we take a look here, this light green sector also performed quite well, not quite as well as the S&P 500. So you can see that it's just a few stocks and a few sectors really driving the market. This communication, consumer discretionary here. If we go down here, we're going to see the defensive sectors underperforming as well. So we have this sector, the communication services, really doing well here, really moving this market up, and also technology at the same time. This This is a graph of the Russell 2000, so the small cap sector, and it reached an all-time high last week, which is great. So it's catching up to the S&P 500. I wanted to show you a little bit of what's taking place. So this is the high yield option adjusted spread. So this is the credit spreads here in blue. And you can see there is a relationship with the credit spreads moving up higher in a riskier situation. The Russell 2000 tends to underperform and vice versa. And we can go through this graph and it's quite a strong relationship overall. Well, what's been happening recently is we're seeing this credit spread move lower. And from that time point, we've been seeing the Russell 2000 move higher. So it makes sense that the Russell 2000 now reached an all-time high. And here we are with really extremely low credit spread taking place. It's kind of bizarre how low this has become. And then the Russell 2000 has poked its head up here. I will say that maybe we can see the continue sideways here with the credit spread. And look what happens when that happens for the Russell 2000. It just moved sideways. Down here, it was moving lower, so it moved higher. Here's a slightly sideways movement here taking place, and another sideways movement for it. What I'm saying is, it's going to be difficult for this credit spread to move lower. The closer and closer you get to lower bound, sure, it can, but at 2.62%, that's really, really low for paying for high yield bonds versus government bonds. It's just basically saying that we're really worried about the risk here. So it's very, very, very difficult for it to move lower here at this point. If it moves sideways, we would likely see the Russell 2000 move this way. And if we see it start to tick up higher, we could see the Russell 2000 come lower. Something to watch out for as well. Okay, here's uranium. I want to show you uranium today. Here's uranium. I'm using URA as a proxy. We saw that consolidation take place, and we have seen that breakout happen. Yes, it's up a lot. It can still move higher, so watch out. It's still got a strong seasonal period ahead of it. Sometimes it starts earlier, but historically a little bit later from here, but it can still move higher. And that's the thing with commodities. They really surprise people that they can just keep going. It's not like a stock where you say, oh, the PE's gone too high, it has to regress back down. The dynamics of the commodity market are totally different. Okay, so what happened with gold last week? We saw gold move higher, and then we saw gold miners move higher. Well, first of all, we saw Jeffrey Gundlach from Double Line. He's well followed. He said that holding a 25% gold position is not excessive. Okay, the average institutional fund holds less than 1%. Okay, gold is only a $22 trillion market, so relatively small compared to the stock market and definitely compared to the bond market. 25% for a position is huge. And it's really becoming, because investors are looking at long-term bonds and saying, we don't trust the governments. They've told us they're going to act recklessly and keep spending. And, we need to be compensated because we expect the yields to move higher on their recklessness. And so we're looking for something else. So this is the narrative is changing for gold. And I've been trying to talk about the narrative switching for a long time, but last week we saw a bit of a switch. And we saw this narrative get picked up quite a bit about Jeffrey Gundlach and his talk about gold. And he's been bullish on gold for quite some time. So Jeffrey Gundlach was not the only one last week talking about, gold should be in a portfolio, the typical 60-40 portfolio. So that would be 60% equity and 40% fixed income. Investors are saying, why? Why would we do this? Because interest rates are looking to move up longer term. We have to do something else. And they're moving into other types of assets, such as gold. And so we're seeing the CIO from Morgan Stanley say that, yes, 20% is not a bad position for precious metals. Jeffrey Gundlach, 25% for gold. So this is really what's driving the market. If you think about how small the gold market is, this is why we can see the movement actually drive the price substantially higher. It has been the non-Western central banks that have been pushing the price up over the last year or so. They've been huge buyers. Well, they've been net buyers really since 2010, but 2022 they saw that big huge step up after the Russian assets were frozen in SWIFT. And we've seen them continue to buy, in particular China, but they're not the only country buying. I want to give an update on the US dollar relative to world currencies. That's the Dixie, that's in blue. And if you take a look here, the US dollar versus CAD, the loonie, that's in red. And you can see that they basically follow each other up and down here, and up and down we go. But look what's happened recently is the US dollar has been underperforming the world currencies in 2025 and even continued later. And look at what's happening. The US dollar is outperforming CAD here, the Canadian dollar, in recent months. So we did see that performance take place where we saw US dollar rise into 2025, and then we saw at the beginning of 2025, we saw that flick of the switch, and basically the US dollar started to underperform dramatically with the whole tariff situation. But we've seen a change here, and we're seeing the US dollar outperform the Canadian dollar. So one of two things is probably going to happen is either the US dollar is going to move higher and start to catch up with this line, or this is going to move lower and the US dollar is going to start to underperform CAD. So why is this happening right now? Well, the Canadian economy is in a very weak situation here. Investors are looking at it and going, there's really nothing out there that says the Canadian economy is going to improve. There's no real strong action plan for that to happen in the short term. So we're seeing the Canadian economy stumble. Had a GDP print, the most recent one was down 1.6%. And yes, it is being hit by tariffs, but it was slowing down already. And the likelihood is that we could see some further slowdown from here. And that's why we're seeing the US dollar outperform the Canadian dollar. We have to watch it because the US dollar does start to pick up in seasonality a little bit here relative to world currencies here, and also CAD as well into December anyhow. And then the US dollar starts to head lower relative to world currencies early in December. And as well with Canada as well, the Canadian dollar starts to outperform at that time. But we'll probably see this movement take place. But I did want to actually show you this difference of what's happening, because there's a lot of this talk right now, but that's very different than this. I want to take a closer look at the US dollar versus the Canadian dollar. A little more focus on this. We've flipped it in this case. So when the line's rising, this means the Canadian dollar is outperforming, vice versa. We just talked about the economy performing, relative performance between Canada and the US having an impact on the currency rate. Another factor that is often looked at is the differential between the Canadian 2-year yield and the US 2-year yield. And another factor is the price of oil as well. So let's take a look at what's happening here with the 2-year differential. So if we take a look, the Canadian 2-year differential is moving higher relative to the US 2-year differential, which means getting closer, and they both have been falling, but the US 2-year yield has been falling faster, so squeezing that differential higher, which should push the Canadian dollar higher. And that hasn't really happened, at least not from this point here. We've seen the Canadian dollar fall. One of the reasons is, if we go all the way down here, is the price of oil has been moving lower. So right now what we're seeing here is this take place where we're seeing the 2-year differential start to flip, and the Canadian 2-year is falling faster than the US 2-year, which is interesting, which could be showing a little bit of strength for the US dollar, also perhaps to world currencies. Price of oil has moved lower here. If we see this turn around here, we could see the Canadian dollar start to pick up here a little bit as well. But seasonally right now, the oil tends not to do well in this time of the year. So right now we're seeing not a lot of prospects for a stronger Canadian dollar, despite what we're seeing relative to world markets. What should we expect in the markets this week coming up? Well, here we are in September. On average, tends to be one of the weaker months of the year. So far, it has not been weak at all. And that can happen. We're perhaps in a little bit of a blow-off top taking place. A lot of retail buyers pushing the market higher. We're seeing institutions step in at this point as well. The market can move higher, of course. And we're at this point seeing the narrative, bad news is being interpreted as good news more. We saw a little bit of a pause where perhaps that was changing, but bad news is good news has come back into style. So yes, we can see the market move higher, but just a couple of warnings overall on this is the first thing is that it's the second half, the last 2 weeks of September that tend to be the weakest part of the market in the year. In fact, the last 2 weeks of September on average are the worst 2 weeks for the S&P 500. So if there's 2 weeks in the market that if you said, hey, I want to avoid 2 weeks of the market every year on average during the year, it would be these 2 weeks coming up. And it doesn't necessarily mean the market's going to be moving down because we have seen a strong market here, of course. But if we take a look at my Thackeray's 2024 Investors Guide, here we can see my chart here that I've got here that for September, on average for the S&P 500 from 1950 to 2022, you can see here that it's the first 2 weeks tends to be actually positive for the S&P 500. And it's the last 2 weeks, the last part of September, where you find the S&P 500 moving lower in this time period. One of the reasons is that right now, well, we're in the blackout period for corporations. They can no longer buy back their stock in this time period here. And that's been a major driver for the markets. Yes, they can restart soon after they announce their earnings, but they've all stopped at this point heading into earnings season. So this tends to be a bit of a negative impact on the market at this time. We just passed by the options expiry date, which tends to be volatile. We did see some volatility in the market, nothing significant, but it can bring more volatility to the market as well. We don't have a lot of earnings coming out here. We're really getting towards the end of the earnings season. Perhaps investors will look at Costco, but we don't see big, huge drivers taking place. And if we take a look at the economic reports, sure, there's lots of economic reports coming out like every week, but we don't see the really big economic drivers coming out this week. Well, you know, with this market, perhaps we'll see the market try and settle in here. We're seeing bad news being interpreted as good news. It looked like perhaps that might have been flipping a little while ago, but right now bad news is good news, and investors are driving that market higher. This rally was being pushed more from the retail side. We're seeing institutions join at this point as well. But here we are in this 2 weeks of the year. I don't see a strong reason for the market to move higher, but yes, it can move higher when you're reaching all-time highs at this point. It's very difficult to say this is the point where it's going to turn lower. But we are in that last 2 weeks of September, which are the weakest 2 weeks of the year. And we don't see a lot of drivers coming out this week that can actually drive it higher. So it looks like perhaps we, other than the momentum that it's already got. So at this time, I'd still be a little cautious in the markets. Thank you very much for joining me today. Please like this video and please subscribe. That way you'll be updated on a regular basis. Thank you very much.